Let's talk to Marc Ostwald. He is a strategist at ADMISI. Very good morning to you, Marc. Right, you sent three fairly complicated charts to finish the week off with. Let's kick off with the first one. What is this telling the audience?
Well, really the charts are about two aspects of the market. We've had this risk-off or bonfire of the volatilities over the past week to 10 days. We are recovering now, obviously. And to really just highlight where the pressure points have been and how little contagion there's been in certain other markets. So this is basically comparing the average yield on US high yield bonds, which is the white line, as measured via the spread over the governments, and comparing that with the thing which would move in the opposite direction, which is the junk bond ETF. So we had a sell-off, but we can already see we're narrowing things up. People have basically taken the opportunity to start putting money back in. Nevertheless, the outflows that we saw for the week to Wednesday, which were reported overnight by Lipper, showed that we had the biggest outflow from high-yield bond ETFs.
Right.
The second biggest on record of over 6 billion. And that followed a fairly hefty outflow the week before as well. So there is a little bit of caution in some risk assets. However, if we go to the next chart, you wouldn't exactly call this contagion. Yes, that looks like quite a sharp move. This is the corporate bond yield spread for investment grade bonds. It looks like quite a sharp movement. Then you look at the fact that the average spread did get to a low of 62 basis points, which, if you think about it, you're chasing down corporate bonds with an average yield spread over treasuries of 62 basis points.
Right,
so you do ask yourself, wow, you must be desperate.
Yep.
And we took it out to 74. We're back to 72 now. It's hardly the end of the world. If you put it in comparison, we're a couple of basis points above where we started the year. I don't think there's many people going to be crying into their coffee on the basis of that. Indeed, from what we've seen, there's been plenty of demand, and you actually get a very, very similar picture if you look at emerging market bond spreads. And there, I suppose, bond and actually EM equity flows. The flows for last week were actually positive, believe it or not. I think a few people would have expected some outflows given the turmoil that we had. But I think really the message there is a simple one, and it's about what's happening with the dollar. With emerging markets, the most difficult thing for emerging markets is when you start seeing not only US interest rates rise, but also the dollar rise. As long as you've got a situation as we have at the moment where US interest rates rise, and we must remember we haven't exactly got to something horrible like 5, 6, 7%.
Yeah.
It's only 3.
Yep.
We got close to 3, which is hardly a king's ransom if you're an investor looking to generate some decent returns on your portfolio. So I think that's the interesting part in terms of the emerging market bond story. It's the carry and the fact that they're obviously faster growing economies, so you want to be involved with their equity markets. But it also tells us something, I think the next chart also tells us something about why the dollar is going to actually struggle to rally. Because we know there's a big dollar short position, but there's just as big, and there has been almost permanently, just as big a yen short position out there in the market. And until we actually start to clear out that short position in the yen, I can't really see how the dollar actually picks up. And the interesting aspect of this is part of this is actually to do with a change in the way that the Japanese investors have been, where they've been allocating to. So they've looked at the dollar weakness, they've looked at the enormous amount of increase in borrowing that the US government wants to do. They know the fact that the Fed, with its quantitative tapering, quantitative tightening, is going to be basically asking them to step up to the plate to buy more treasuries, and they're allocating more money to Europe. And as a result, it's the pickup into Europe that they're looking at, though ironically, when you look at the spread, you think, well, really? I mean, bond yields are at 0.75, pretty much at their best, whereas in dollars, you can get almost 3. So it is interesting from that aspect, but until we actually start clearing this out, and we may a little bit, part of it will be cyclical. If you actually look at the beginning of 2017, you'll see that, basically the beginning of the year, just as we come up to the Japanese financial year end, you start to see quite a lot of that short seasonally taken off the table. It's still quite big structurally, but it is being seasonally taken off the table. But I think this is the key. We need to clear out the short yen position before we can actually start looking at those US government bond yields and start to say, you know what, actually I quite like this. I think the other point on this is a point of people are arguing that one of the reasons for the dollar's weakness is that everyone's now looking to the point where the ECB and the Bank of Japan effectively start playing a bit of catch-up with the Fed. Well, let's put it this way. The more the yen strengthens, the more the euro strengthens, the longer it's going to take for them to actually even think about playing catch-up. The ECB will probably start, end its QE program in September, but a rate hike, I still think we're quite a long, long way from that.
On that note, Mark, thank you very much indeed.